All right, welcome. Today, we're going to dig into two really big opportunities in the tech world. These are places where the market is frankly scared, and that fear might be creating some incredible hidden value. So let's just jump right in. There's this massive fear that's kind of gripping the market right now, and it's being fueled by some pretty powerful statements, like this one from the CEO of NVIDIA. The whole idea is that AI is just going to completely make traditional software obsolete. And, we're not talking about some tiny little corner of the market. We're talking about a $1.2 trillion industry, the entire enterprise software space. And a lot of people think it's about to be completely upended by AI. And you can see that fear playing out right here in the actual stock prices. I mean, look at this. Except for a real high flyer like Snowflake, you've got major players, Salesforce, Workday, ServiceNow. They've all been hit pretty hard over the last year. It's clear that investors are getting nervous. But here's the question. Is this whole AI apocalypse for software actually going to happen anytime soon? When you really start to dig in, the reality, it's a lot more complicated than that. Okay, so there are really two big reasons why this fear is probably overblown, at least for now. First up, AI is still, well, it hallucinates. It just makes stuff up sometimes. And you just can't run a business's most critical operations on a system that might just be flat out wrong. And number two, these software companies, they're not just sitting on their hands. They're building their own AI, like Salesforce's Einstein AI, right into the products you already use. And that brings us to the really crucial point here. If you want to find the real value in this kind of environment, you have to look past those scary headlines. You need a smarter way to figure out what these companies are actually worth. So, okay, how does the market even look at these companies? Well, if we use a pretty standard metric, price to sales, the story seems really simple. Salesforce is trading at about 5.7 times its sales. Snowflake? It's way up there at 16 times sales. On the surface, Salesforce looks like a total bargain, right? But wait a second. That simple comparison is missing probably the most important piece of the entire puzzle, and that's growth. I mean, a company that's growing at 30% a year should be valued higher than one growing at 10%. It just makes sense, doesn't it? Okay, so let's bring in a much better tool for the job. It's called the price to sales to growth ratio, or PSG for short. And what this does is it levels the playing field. It takes that price to sales number and adjusts it for how fast the company is actually growing. Now, this is where it gets really interesting. When we apply this PSG logic, something pretty amazing happens. You take Salesforce, Snowflake, and ServiceNow. I mean, these are companies with totally different growth rates and valuations on the surface, but they all end up with almost the exact same PSG ratio, around 0.57. Basically, the market is saying that once you adjust for growth, they're all worth the same. So, if the market values them all the same on a growth-adjusted basis, what's the next logical question? Well, it's gotta be, who's actually making any money? And bam, here's the difference, clear as day. Salesforce is solidly profitable. We're talking a 24% operating margin. Snowflake, on the other hand, is still in the red. Okay, so to really zero in on the best deal, we can use that same growth adjustment trick one more time. But instead of looking at sales, let's look at earnings. For this, we use a classic metric called the PEG ratio, which is price to earnings to growth. And here it is, the final piece of the puzzle. When you adjust for how fast their earnings are growing, Salesforce comes out as the clear winner. It has the lowest PEG ratio of the bunch. See, it's not just that it's growing, it's turning that growth into actual profit way more efficiently than the others right now. Hey, if you're getting some value out of this kind of analysis, do me a quick favor and hit that like button and make sure you're subscribed to the Stock Market Mojo YouTube channel. It honestly helps a ton and lets us keep making more of these explainers for you. All right, let's take that same way of thinking and apply it to our second company, Super Microcomputer. Now, this is a stock that's facing a totally different kind of fear, but trust me, it's just as intense. So what's the big, scary headline for this one? Well, it's a huge sell rating from none other than Goldman Sachs, and their main argument is that the company's profit margins are shrinking. But you guessed it, just like with those software stocks, that headline does not tell the whole story. So let's dig in and see why the bears, the people who are negative on the stock, might be missing the bigger picture. So here's the debate in a nutshell. On one side, you've got the bears, and they are laser focused on those falling profit margins and all the competition. But on the other side, the bulls, they see a company that has a massive 27% market share in the AI server space, which is just exploding right now. And they have that share because their engineering is just plain better. And the whole case for the bulls really kicks off with this one number, 65%. That's the revenue growth Supermicro is expecting this year. That is just absolutely explosive growth. So that brings us to the million-dollar question, right? How in the world do you value a company with that kind of insane growth, even when its profit margins are getting squeezed for a bit? The key, just like before, is to look forward, not backward. And we can do it in 3 easy steps. Step 1, take the current market cap. That's about $17 billion. Step 2, use this year's expected sales, a whopping $36 billion. And step 3, you just divide the market cap by those expected sales. That gives you what's called the forward price-to-sales ratio. And the number you get back is, honestly, it's pretty jaw-dropping. A forward price-to-sales ratio of just 0.47. Let that sink in. The company is trading for less than half of what it's expected to make in sales this year. You'd have to go all the way back to when people were afraid the stock was going to get delisted to find a valuation this low. So, okay, we've looked at enterprise software, we've looked at AI servers. What's the one big lesson we can pull from both of these stories? It all comes down to this. The market often overreacts to fear, and those fear-driven headlines can be so misleading. It doesn't matter if it's the threat of AI or a bearish report from Wall Street, the real opportunity is almost always found when you look past that noise, adjust for growth, and uncover that hidden value. So the question for you is, what market fear are you going to question next? And hey, don't forget to subscribe to the Stock Market Mojo YouTube channel.